Laqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price. It can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. Right. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
2 p.m. on Wall Street, we have both the stock and bond markets under pressure at this hour, all ahead of Fed Chair Jay Powell's speech to the Jackson Hole Symposium. The Fed is sponsoring that, and we'll be looking for his comments on Friday. Now, we already know that many Fed officials have repeatedly said interest rates are going higher. Nonetheless, many in the market, or at least some, have speculated on a looming pivot in the Fed's thinking given signs of economic weakness. Powell, for his part, is likely to push back on that notion and emphasize the threat of higher inflation and the Fed's commitment to fighting it, even if it causes pain. If you look at the bond market right now, we are up in yields across the curve. On the long end, a 10-year Treasury higher by more than 5 basis points to 3.02%. At the short end, the 2-year Treasury is up more than 10 basis points to 3.34. Quick look at the equity market. We are weaker across the board. Dow Industrial Average right now down about 1.9%. In the broader market, S&P 500 weaker by more than 2%. This decline is being led by consumer discretionary, consumer services, that would be communication services as well, and information technology. In the NASDAQ Composite, we're down about 2.4%, so the weakness in consumer tech really showing up on this front. Crude oil prices right now remain under pressure. We are well off the worst level of the day. WTI at the low point was trading $86.60. Right now, we are about $90 a barrel, off about 0.7%. Earlier, the Saudi Arabian oil minister was saying extreme volatility and the lack of liquidity in the crude oil futures market, it's really disconnecting prices from the fundamentals, and OPEC Plus may be forced to act. Lately, prices have been pressured by concern over weak global growth combined with the possibility of more Iranian crude coming to market. Right now, WTI, $90.10 the barrel, and Brent crude at $95.80. That is your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And a very good afternoon, everyone. It is Monday, August 22nd, 2022, live in our Bloomberg Interactive Brokers studio, streaming on YouTube. I'm Carol Masser. My co-host Tim Stenovic is off this week, and with me for the next 3 hours, lucky for us, Bloomberg News senior markets reporter Katie Greifeld, also host of ETF IQ on Bloomberg TV. Hi.
How you doing?
I'm okay. How are the markets doing?
Not too hot right now, Carol.
I know. A little bit of a bummer. I feel like the focus is all on the end of the week in Jackson Hole.
Mm-hmm. Yeah, and some jitters before the big dance, it looks like.
Yeah, absolutely. We're going to talk about that in just a moment. We're also going to talk about why Amazon and so many others are in an M&A fight for Signify. This kind of felt like it came out of nowhere, Katie.
I know, Signify, apparently the hottest item on the market right now.
Exactly. We're also going to check in with the individual who will help scale up the first Apple iWatch. She's now investing in essential industries, embracing the digital age. And then we've got a magic mushroom pill that's taking shape in a network of startup labs. There's a lot of companies working on this. Mm-hmm. All right, and let's not forget Zoom after the closing bell. First up, though, let's get to the Market Drivers Report. Let's set your business week agenda on this. Yeah, it's turning out to be another busy Monday. In the house is back with us. She's been traveling the world. Kriti Gupta, markets correspondent at Bloomberg. She's here in our Interactive Brokers studio, along with Jess Menton, equities reporter at Bloomberg News. Her column was among the first that I read in on this morning. Let's start with Kriti. First of all, welcome back.
Thank you.
Do you feel like much has changed since you went away?
I feel like I came back and it's almost the same, but not the same. That's
okay.
Which I think is, I mean, look, the conversation is still all about the Federal Reserve, duh. But what has changed is this new emphasis on financial conditions, which
yes.
I kind of came back and I was like, well, they've been tightening since March. So what is the new obsession with financial conditions? And I think it's pretty interesting that today is the day we come and talk about that, because take a look what the market is doing. The S&P 500 down about 2%. The NASDAQ down 2.5%. But it's not just a stock story. Bonds are selling off. We've got a 302 on the 10-year yield. You have commodities that were down, by the way, almost 4% at one point in the session, and they've come back and they've rebounded. I was looking at NYMEX crude, and it was an 89 handle.
Mm-hmm.
I mean, shift. Oil in the 80s is wild to me, given
it's like it's on sale, Katie.
Oh, I mean, it almost feels like it, but there is one common theme, and it's the dollar that just gets stronger and stronger and stronger. What's interesting to me, and we just had a guest on Bloomberg TV talk about this, is the market almost kind of has been digesting rate hikes in a way that I don't think anyone expected. So why the jitters on a more hawkish Federal Reserve? And I think that's the question that I have. I don't have the answer to it, But that's the question I have.
Well, if we think about what we've heard from Fed officials over the past few weeks, it feels like, Jess, that they've all been banging the same drum that we're not close to stopping. That inflation print that we got in July, okay, was a little bit softer than expected. Not a victory lap, though. It feels like markets were fighting that message almost up until this point.
Exactly, they were, and you had a number of Fed speakers coming out even after the Fed's last meeting, sort of reiterating the point that, hey, we think markets are getting ahead of themselves, one of them being Kashkari coming out and continues to drive home that point.
The dove, the guy who's been really dovish when it comes to the Fed.
And he's actually supposed to speak again tomorrow. He's one of the few Fed speakers ahead of Jackson Hole later this week, so it'll be interesting to see what else he says, but I would imagine it's probably very similar to what he has been saying with that sort of stance. And again, just looking at what's going to happen with Jackson Hole, obviously it starts on Thursday, but the bigger day is going to be Friday. That's when we will hear from Jerome Powell.
How do you square that and what we might get from the Fed Chief Jay Powell with your story today, which, as I said, was one of my first read-ins this morning about Ned Davis, somebody we follow, and the bullish call that they've got on stocks?
They did. So for the first time since January 20th, they are now having a bullish call on global equities. They're still neutral when it comes to U.S. stocks, but they've been growing more bullish on U.S. stocks since early July. And they also, in July, they had downgraded energy to market weight from being overweight, and they had upgraded discretionary to market weight. But just looking more from a global perspective and seeing kind of the stance they're taking, a bit counter to when you're looking at, say, Morgan Stanley, still sticking with that sort of bearish type stance. But then again, you look over to JP Morgan, Marko Kolanovic. He still has continued to stick. And again, today, earlier, about an hour ago, he put out another note sticking with that bullish call. So you're seeing sort of what's happening on Wall Street and a lot of these strategists, just fiercely trying to contend whether or not we've hit that market bottom or not.
Death, taxes, Kolanovic being bullish on equities. It's nice to have something there. It's nice to have something to rely on. But Creedy, I mean, this is a very macro conversation. Somehow we're still in earnings season. We have Zoom after the bell. We have NVIDIA later in the week. Does it matter at this point? Do we still need to be keeping an eye on these earnings?
You know, there's so many people who say that we do. We had the head of global equities for UBS Wealth Management just on, David Lefkowitz, and he said, yeah, it's all about corporate profits. That's really all the market cares about. I think there's another case to be made here, though, that you also have to look at what's happening globally, because at the end of the day, there is a dynamic that is decades long in the making, is that when everything goes wrong in the rest of the world, think of a European recession, a Chinese slowdown, you buy American. And right now, they're doing
Davis
that.
doesn't, apparently.
What does it?
Ned Davis.
Oh, yeah.
Still. But, you know, and I think what's interesting about the stocks call, let's go global here, because Ned Davis is...
There is the quandary, right? Like you're saying, buy U.S. would make the most sense when everything is going wrong, yet that's not what Ned Davis is saying.
But there's a difference between buy U.S. stocks and buy U.S. via the dollar, and that people are doing it via the dollar right now, which I think is interesting, and that's why you're seeing a lot of pain in the commodity space. This macro hedge that was supposed to be like the end-all, be-all protection for your portfolio, well, it's collapsing before your eyes, and the other alternative was the dollar, and that's what's working.
I have to say, I'm going to sound like a broken record today, so Katie, get used to it, but I'm obsessed with the most read story on the Bloomberg about the world's biggest, or some of the world's biggest bond investors talking about that maybe we are at an end of low inflation in terms of an era. And I got to say, just that really resonates with me when I think about the pivots, forgive the use of my word, but in terms of moving towards all energy, high commodity prices, and the pushback on globalization, like I do wonder if there's a rethink here.
Right, and Bespoke, they actually just put out a note talking about how after hitting a record high in the middle of June, gas prices have actually fallen every single day in a row, what is now tied for the second longest streak of daily declines in prices. So it's interesting to seeing that kind of correlation when we're looking at what exactly does that mean for the U.S. consumer and how that obviously transponds to what the Federal Reserve is doing, because again, we're talking about tightening financial conditions.
Right.
What does that exactly mean? Like, again, with the Fed's, Chicago Fed's activity index today actually showing some signs of loosening there. So that does make it a bit challenging for what the Fed's goal actually is.
All I would say, fossil fuel, it's a fixed amount, everybody, and the big oil guys are saying we're not going to drill anymore. So
scarcity, so important.
Yep. Kriti Gupta, Jess Menton, thank you so much. All right, let's get to World and National News and Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. President Biden says the U.S. is stronger, more resilient, and healthier because of Dr. Anthony Fauci. The nation's top infectious disease expert announced today he'll be stepping down as Biden's chief medical advisor at the end of the year. Fauci says he'll also be leaving his role as the director of the National Institute of Allergy and Infectious Diseases. Looking ahead to the midterm elections, there's a sense that while there will not be likely a blue wave, there might not be a red one either. Bloomberg's Amy Morris reports from Washington.
Democrats are growing increasingly optimistic that their losses in November won't necessarily be catastrophic. They're counting on the Trump-related chaos dragging down the GOP. While the House is still nearly certain to flip to Republican control, the Senate is looking more like a toss-up. And if Republicans do take control of both chambers, they're not likely to have a big enough majority to overcome a Biden veto of any legislation. In Washington, I'm Amy Morris, Bloomberg Radio.
Both New York and Florida have primaries tomorrow. A key House race in New York pits veteran Congress members Jerry Nadler and Carolyn Maloney against one another, a situation created by redistricting. And in Florida, Democratic Congressman Charlie Crist faces State Agriculture Commissioner Nikki Fried in the race to see who will run against Republican Ron DeSantis, the incumbent in the governor's race. 3 law enforcement officers in Arkansas have been suspended after a video posted on social media showed a suspect being held down on the ground and beaten by police. Arkansas State Police say they are investigating. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Nancy Lyons.
Nancy Lyons in our 99.1 newsroom in Washington, D.C. Carol Masser, along with Katie Greifeld here in our Interactive Brokers studio, streaming on YouTube. A couple stories about housing markets here in the New York Metro, and one on renting and one on what's going on in the Hamptons. Looking for something on sale? Go out to the Hamptons.
Yeah, I'm a little farther away from home looking for bargains in the Hamptons, but it did catch my eye, that first story on renting. NYC renters search for cheaper options farther from Manhattan. According to online searches last month from Street Easy, neighborhoods in South and East Brooklyn, as well as Central Queens, saw spikes in searches, and search volume declined in traditionally popular areas such as the West Village, the East Village, Greenwich Village, Lower East Side, and Soho. Pretty interesting.
So all downtown. You live in New York.
I do live in New York. I live on the Upper East Side. I don't see any mention of. I've been there for 6 years. There's not a lot of movement in and out, I feel like.
Do you ever search like real estate markets?
Constantly.
Okay.
Constantly.
Do you look New York? Do you look outside New York?
Oh, I dream of Jersey City.
You
and I. Yes, you
we
and I
have talked about it.
Yeah. I just hate getting back over the bridge into the island of Manhattan. It's torture every single Sunday.
It's not like you need a passport or anything, kiddo.
I know.
You're in
that's
New Jersey.
True.
You
I know. I sat in
Jersey.
traffic for 90 minutes last night for a trip that should have taken a little under an hour.
At the tunnel?
Yeah.
Or the bridge?
No, at the bridge. I always take the bridge.
All right. So it can be, for those who live in the New York City metro area, you can sit at one of those crossings forever. You can be like sailing through the city, and then all of a sudden you're just stuck for an hour or two.
Yeah, load up the podcasts.
So anyway, renters are looking for options further from Manhattan. As for the Hamptons story that really caught our attention, looks like some listings have cut their asking price out in the Hamptons by $500,000 or more as demand dries up in the luxury enclave on Long Island.
And of course, this would have been unimaginable just a few months ago. Home values in the luxury Long Island enclave rose to record highs during the pandemic as wealthy New Yorkers fled the city, but that feels like a long time ago, Carol.
And that would be kind of a mega commute for you. I'm just going to point that out. But
true.
Great for riding.
Not bad.
This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Both the stock and bond markets are under pressure today ahead of Fed Chair Jay Powell's speech. On Friday, he'll be talking at the Fed's Jackson Hole Symposium. He is very likely to dismiss the idea of a Fed pivot and deliver a very hawkish message. Right now in the bond market, yields are up across the board, particularly at the short end, where a two-year Treasury now is at 334. We're up nearly 11 basis points on the day. A 10-year higher by more than 5 basis points in yield at 3.02%, the first time we've been above 3% in about a month. Now, in terms of the equity market, we are in retreat across the board. Dow Industrial Average right now is down 1.9%, the S&P weaker by more than 2%. That's your Bloomberg Business Flash.
Close. Bloomberg's comprehensive cross-platform coverage, bringing you insight on what to watch ahead of the U.S. market close, starts right now.
And a very good afternoon, everyone. Welcome to the kickoff to the close. Carol Massar, along with Katie Greifeld. She is in for Tim Stanovec on this Monday. We welcome our TV colleagues, Caroline Hyde, Taylor Riggs, and Gina Martin Adams. We're going to walk our Bloomberg audiences on TV, radio, and YouTube as we march to the closing bell on this Monday. And you got to say that when you look at the trading right now, lots of nervousness ahead of Jackson Hole and those comments from Fed Chief Jay Powell later on this week. What does it mean? The S&P down more than 2%, 2.5% down on the NASDAQ, and the Russell also having a tough time, down about 2.2%. We've also got to mention that those Treasury 10-year yields topping 3% for the first time in a while, it seems like.
And Carol, I love that you sort of kick us off with the equities. I'm going to be taking a look at some of the key things that we're really watching into the closing bell. I'm focused on euro-dollar parity, and I'm curious, a lot of people thinking this is euro weakness, and of course, some of the dollar strength as we really prepare for Jackson Hole and some of the key insights and signals we'll get from this Federal Reserve. And right now, going again through dollar parity on terms of the euro. And Gina, I think what stands out to me, some of the comments we've gotten from Jordan Rochester, for example, saying that he's looking at 9.75 by the end of September, that parity level actually could be behind us as we go sort of weaker on euro and a lot of this dollar strength.
Right, and think about just the last couple of weeks, how many people were betting against sort of finally maybe that king dollar story was ending, and yet here we are with just a persistence of this currency pressure impacting the equity markets, impacting the global markets, impacting the bond markets. How much more pain can we take is a big question facing investors.
It's a pretty existential question, too. How much more pain can we take? I want to talk about an area that's under a lot of pain right now. That's the meme stocks. That frenzy last week seems like a distant memory at this point. Bed Bath & Beyond down about 13% today. But if you look at the year-to-date performance, it's pretty interesting. Actually, your outperformer, GameStop, only down about 6% or so this year, actually outperforming the S&P 500. But as you can see, it's been a very, very bumpy ride to get there.
And Caroline, I actually wonder if some of this could be some of the fundamental news. We know that APE, the AMC equity preferred shares, the preferred equity shares, I should say, actually started trading today as well. So you're getting some news besides just maybe meme stocks. Some of that bubble had popped as well.
And a supply chain concern when it comes to Bed Bath & Beyond, whether they can actually get their products amid some of the payment concerns surrounding that business. And I want to talk about supply chain a little bit more because I want to flip it over to the UK. I've just flown back from there. And, well, on Sunday, we started to see the walkout of the dock workers. Just think how worried we were about the dock workers strike potentially here in the US. Well, it's happening in the UK for up to some 8 straight days. We're on day 2 already. And in fact, earlier, Bloomberg managed to speak with the British Ports Association CEO, Richard Ballantyne, about the absolute impact on the consumer once again. Just take a listen.
It is a kind of issue for the logistics industry and the freight industry and the shipping sector here in the UK. The issue is if you do reroute freight away from its traditional travel plans, etc., there will be a cost, and those costs will be passed on to importers, traders, and potentially ultimately consumers.
And of course, this speaks to a wage price spiral as people, the dock workers, want higher wages to keep up with the 10% inflation that could go to 18%, according to Citigroup. But of course, they want higher wages, so the inflationary pressure goes up that much more. It becomes this vicious circle.
And it's such a good reminder of all these different inputs that are affecting the inflation that is affecting consumers right now. It's not just higher energy prices, it's these sort of long-standing structural issues that we're having with supply chains more than 2 years into this pandemic, Carol.
God, I feel like the two of you have set me up perfectly for what I want to talk about. This is one of the most read stories on the Bloomberg on this Monday, and basically it comes from some of the world's biggest bond investors who are saying the market is wrong in expecting that central banks will win in the war against inflation. We've got a chart up for those folks on TV and YouTube. For radio, it shows U.S. two-year break-evens, a bond market proxy of U.S. inflation and expectations over the next 2 years. It has cut nearly in half since March to about 2.7%, not far above the 1.9% average increase in a broad price gauge in the 20 years before the pandemic. But PIMCO, Capital Group, and Union Investment are saying, yeah, rate hikes will help bring consumer prices down somewhat, but it's not going, that high prices and inflation are really going to stay with us for a long time because of a lot of macro trends, including the pushback on globalization, Caroline.
Precisely, and we think some of that data that came out of China and the reduction in those relations, particularly from an import-export perspective, particularly between the US and China, Gina.
Yeah, well, let's move macro to micro because guess what? Earnings season's not quite over. We still have more earnings to come with Zoom this afternoon. My colleague John Butler in BI says we really need to look at the fourth quarter guidance. I mean, the company has told us, you know what, second quarter, third quarter, it's not going to be a great environment. This is a tough year for the company that is comping to an extraordinary year. It's in a transition toward enterprise and away from that retail consumer. It's changing its business model up, but the expectation is it all starts to get better as they roll out these new products with the fourth quarter. Will they be able to satisfy that expectation is a key question for this afternoon.
And with that enterprise spending, which maybe you would know this better than I would, but maybe more of the profitable businesses of them all, are corporations going to come in and back that up as we think about some of the corporate macro headwinds and the way that they spend on IT? Is this a place where they're going to say, despite recessionary talks, we're not going to cut back, we're still going to continue to do those Zooms?
All right, some big macro ideas to think on a very important week, certainly for investors. All right, guys, we're going to be back in 30 minutes time for a countdown to the close. And then, of course, we're going to count you down to the market close with Beyond the Bell at 4 p.m. Wall Street time.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week on radio, on YouTube. Carol Masser along with Katie Greifeld in for Tim Stenovic. There's a lot of stuff that we got to think about this week.
There is a lot of stuff to think about this week. When you look at what the market is thinking about, it is just red on the screen. There's only 16 stocks higher in the S&P 500 right now.
I had a really hard time finding gainers today, but you were like, what should I choose?
I'm on Easy Street. Looking forward to that 4 p.m. simulcast.
Okay, we'll talk gainers and decliners then. In the meantime, this is Bloomberg.
broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Gosh, if only something was going on with some big Fed officials and central bankers around the globe this week that might give us some idea about, monetary policy. Just,
I know. It's just another summer Friday, quickly approaching. No nervousness on Wall Street to speak of.
We jest. Of course, Jackson Hole, and we're going to talk to our own Mike McKee about it all in just a moment. First up, though, let's get back to your top business stories and Doug Krisner.
Hey, Carol, both stocks and bonds are under pressure today ahead of Fed Chair Jay Powell's speech at Jackson Hole on Friday. He's likely to dismiss this idea of the Fed pivoting and instead deliver a very hawkish message, reinforcing the idea that inflation remains a threat. The Fed is committed to fighting it, and that could happen even if it causes a little bit of pain. The yield curve remains inverted, although we are up in yield terms across the curve today, particularly at the short end. A 2-year Treasury that's up nearly 11 basis points now, 3.34. A 10-year that's above 3% for the first time in a month at 3.03%. The equity market is in retreat. Dow Industrial Average down about 1.9%. The S&P weaker by nearly 2.2%. And given weakness in the information technology space, the NASDAQ Composite is down about 2.5%. It's not just infotech. We've got consumer discretionary and communication services, along with the financials moving lower. And the price of crude oil, it's been a volatile day. Right now, WTI looks as though it's going to close the New York session down about 0.6% at 90.23. Earlier in the day, Saudi Arabia's oil minister said extreme volatility and the lack of liquidity in the oil futures market, it's really disconnecting prices from the fundamentals, and that may force OPEC Plus to act. At the low point of the day, we traded 86.60. Again, the New York close 90.23. Lately, crude oil has been under pressure. A lot of concern here about weaker growth going forward, given the state of the global economy. That, in addition to the possibility that we're going to see a lot more when Iranian crude may make its way to the market. I mentioned the move up in rates. Well, that's one of the reasons we're seeing a stronger dollar today. The Bloomberg Dollar Spot Index stronger by about 0.6%. The inverse of that, a much weaker euro, down 1% against the greenback right now, below parity, 99.34 U.S. cents. I'm Doug Krisner. That's your Bloomberg Business Flash.
Yeah, gas down here, but I'd hate to be over in Europe right now. All right, Doug Krisner, thank you so much. So top of mind this week, of course, is the gathering of global economists, central bankers to the Kansas City Fed's annual monetary policy symposium in Jackson Hole, Wyoming. Topic of this year's conference, reassessing constraints on the economy and policy. All right. Top of mind, of course, is Jay Powell, 10 a.m. Wall Street time on Friday. So let's get more from our Bloomberg News International Economics and Policy correspondent, Michael McKee, who is going to be headed on the Bloomberg jet very soon and headed out west.
If only we had a Bloomberg jet.
If only. All right. So Katie and I have been having, I thought, kind of a smart conversation behind the scenes here before we got going. Kind of smart. I always preface because somebody's like, that wasn't so smart on social. But Jay Powell never used the word pivot.
Right. He never said that. The market said that after his last news conference when he said, at some point we may find it appropriate to slow down the pace of rate increases. Slow down the pace of rate increases. And they've been at 75 the last two meetings. And until June, 50 was a big move. Now, the fact that maybe they would do 50 is seen as a pivot. I'm not sure what he says to that. It's going to be hard for him to say anything that's really different from what he's already said, because the Fed has been saying all along, we're going to keep going until we bring inflation down. We're going to raise rates to neutral or above and then keep them there. But the market thinks they're going to stop raising rates and start cutting rates. And where this comes from, I don't know.
Well, again, being a fly on the wall during the commercial breaks, always kind of cool around here at Bloomberg. But Katie and I were saying to you, well, what was the significance, though, of Jay Powell saying that, at some point we will slow things down? Because he chooses his words carefully. This is a smart man.
I think he was trying to say that we're not going to do 75 at each meeting, and maybe we don't need to do 50 at each meeting. We will get to a point where we're getting close to where we think the economy will be affected enough by interest rates, which admittedly is going to be a guess on their part. But remember, and this is what led to Esther George's dissent in June, monetary policy works with a lag. So what they're doing today will hit the economy in 9, 12, 18 months. And so they have to try to guess where the economy will be and what impact that will have. One of the arguments you can make for what the markets are doing is they think we're going into recession within that period, and therefore the Fed will have to cut rates. The other is that they don't believe the Fed.
Can we talk about sort of, it feels like the Fed over the past decade has taken on the role of the world's central bank, but to think that the Fed, or at least the market thinks the Fed could be cutting rates next year when Europe is going to be dealing with these very high inflation prints, just thinking about what's happening in the energy complex over there right now, it sort of almost feels like they could be giving up that role if they're not necessarily trying to fight inflation in Europe. They're worried about a U.S. recession.
Well, this is always the problem, is the Fed does what's best for the United States economy, and the rest of the world kind of has to go along with it. It's not just the last decade. You go back to when John Connolly, the Treasury Secretary, said, it's our dollar, it's your problem.
Yeah.
And that's kind of where we are right now, is the more the Fed raises rates, the harder it becomes on other countries. But it's going to be interesting to see how this all develops over the next 6-8 months, because Europe's not just going to have an inflation problem. They're going to have a recession. A lot of people think they may be already entering into one. And so it's going to be really hard for the European Central Bank to do something at this point. I mean, recessions tend to cure tend to cure inflation, but it's a painful process.
So if we think about what the setup in Europe could be, it feels like we've put to bed stagflation fears in the U.S., or at least everyone's tired of talking about them. But could we actually see a stagflationary environment in Europe?
I suppose you could, but I think the better bet is you're going to see a recession in Europe. So no growth at all, but inflation. And the inflation rate will be largely made up of energy. And so it would be a kind of a stagflation, but not the same thing that we think about from the 1970s here in the United States. It's just a very high energy thing. But you have a recession, that'll cut energy use, cut energy demand. Their problem is they're so dependent on natural gas.
Right.
Is what's going to hurt them, as opposed to the way gasoline did it to us.
Mike, only got about 30 seconds left here. How much, I know financial markets are not on the Fed's mandate, but how much does Jay Powell want to see maybe a certain kind of market reaction perhaps on Friday, or not?
Well, he would like to see as little reaction as possible. That's kind of the way they go into these things and out of these things. It's hard to know which way the markets are going to react, because they want something that he can't deliver. They want to know, we're going to raise X on such and such a date at such and such a time, and he's not going to know that.
But the dot plot certainly says to us we're going to continue raising
rates.
Well,
we get a new dot plot in September, so we'll see.
Okay. Stay tuned for that. I like to call it the scatter.
My tease ahead.
Looking forward to your trip and your reporting. Our own Mike McKee, of course, here in studio with us. Let's get back to World and National News. Off to D.C. we go, and Nancy Lyons. Hey, Nance.
Thanks, Carol. Dr. Anthony Fauci, who has served as an advisor to 7 presidents and spent more than half a century at the National Institutes of Health, says he'll leave government service by the end of the year. Dr. Asha Shah is director of infectious disease at Stanford Health and says Fauci leaves quite a legacy.
He stays on point. He sticks to the facts. He guides, the country the right way in terms of the clinical knowledge, the epidemiology, the data. Everything is evidence-based. And that's nice to see in someone holding a position that he holds.
Dr. Asha Shah tells Bloomberg it'll be tough to fill Fauci's shoes. He says he's not retiring in the classic sense, since he says he wants to travel, write, and encourage young people to pursue government service. Diplomats from the European Union and Iran may meet this week to discuss saving the 2015 nuclear accord. EU officials say Iran has sent a reasonable response to their latest proposal. Bloomberg Government's Emily Wilkins with the latest.
One advisor to the Iran negotiating team says that Tehran wants to ensure the U.S. will pay a price if they withdraw again from the agreement, as it did under Trump. But at this point, there do seem to be some optimistic signs that they might be able to get back to an agreement on the nuclear deal.
Bloomberg government's Emily Wilkins. President Biden spoke yesterday with the main European countries involved in those talks on the latest attempt to salvage the accord. Today, a State Department official said there are still some outstanding issues that need to be resolved. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much, Nancy Lyons, in our 99.1 newsroom in Washington, D.C. All right, this just popping up on the most read on the Bloomberg just a few moments ago, following a headline that crossed Elon Musk subpoenaing?
I don't actually know.
Okay,
Sent a
subpoenaed.
subpoena.
Boy, man, it is a Monday. Elon Musk subpoenaed former Twitter CEO Jack Dorsey as he fights a lawsuit by the social media company seeking to make him complete the $44 billion buyout that he proposed. What does he want?
It's a great question. And you and I were just having this conversation that we thought relations between them were pretty friendly because Dorsey, of course, he's the Twitter co-founder. He had been a backer, or probably still is, we're not super sure, of the Musk bid. He had tweeted back in April that Musk was the, quote, singular solution I trust, end quote, to take over the company. Dorsey, of course, stepped down as Twitter CEO last year.
Can you tell that we're getting ready for a trial? This trial begins October 17th and is expected to last 5 days. We know this. Dozens of people, banks, and funds have been subpoenaed in the legal fight playing out in the Delaware court over this deal of Elon Musk, who made an offer to buy Twitter, kind of said, I don't need to look at too much, right? Like, I'm just going to do this. And then it looks like he either got cold feet.
Yeah, of course, Musk has said that Twitter wasn't honest with him about how much of its customer base is made up of spam and bot accounts, if you will. Earlier this month, he had accused the company of hiding the names of workers specifically responsible for evaluating that proportion. Twitter says his complaints are a pretext for him to walk away.
Yeah, it's interesting. A lot of subpoenas have gone out, including to the former head of consumer product over at Twitter, and then the individual that was formerly in charge of revenue products over at Twitter. So there's a lot going back and forth here. I don't know. If you were a betting person, what would you think in terms of how this will play out?
I have no idea. All I know is that as a journalist, not a bettor, I'm so excited to see how this lawsuit plays out because it really feels, I don't know, kind of like a coin flip. We'll see.
Yeah, Twitter right now down about 2%, but in an overall downward market on this Monday. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Showers passing on by, low temperature.
We're about an hour and 12 minutes from the closing bell, and it looks as though the equity market is just at session lows right now. The S&P 500 down about 2.2%. Generally speaking, it's the stock market and the bond market that are both under pressure ahead of Fed Chair Jay Powell's speech. It's scheduled for Friday at the Fed's Jackson Hole Symposium. He's likely to dismiss this notion of a Fed pivot and instead deliver a very hawkish message. Right now, 10-year Treasury up by more than 6 basis points and yield at 3.03%. Big move higher on the 2-year yield. We are at 334, a gain of nearly 11 basis points. So we have the Dow Industrial Average down 2%, S&P 500, as I mentioned, weaker by more than 2%. Look at the NASDAQ Composite, down right now by more than 2.6%. So broadly speaking, consumer discretionary, communication services, and information technology shares moving lower. A bright spot, shares in Signify Health. The stock is rallying by more than 31% right now. We are told many companies, including United Health, Amazon, CVS Health, and Option Care Health, are all competing to acquire Signify. This is the home health technology and services provider. I mentioned the move up in rates earlier. We have, as a result of that, a much stronger dollar with the Bloomberg Dollar Spot Index higher by about 0.6%. And euro weakness today, a big story in and of itself. We are down more than 1% against the greenback, trading below parity now at 99.33 U.S. cents. I'm Doug Krisner, and that is your Bloomberg Business Flash.
You know, Doug, Powell never said pivot.
He didn't?
No.
Who said pivot?
Doug Krisner did.
No, I knew he wasn't going to. People in the market have been saying pivot, right? Boy, you're teasing me again. It's Monday. Can you wait till midweek for crying out loud?
All right, I'll hold off until Wednesday. All right, Doug Krisner there with a business news flash. All right, we talk a lot about this here on Business Week. The growing business of magic mushrooms, recently a takeover in the pursuit section of the magazine. We've got an update in the new issue of Bloomberg Business Week out later this week on how the medical benefits of psychedelic drugs have gone from the age of Aquarius punchline to solid science, but the startups racing to market might still be getting ahead of themselves. Those words from Kristen V. Brown and Drake Bennett reporting out this story. Let's get more from Kristen. She's healthcare reporter at Bloomberg News. She's on the phone from Brooklyn, and Jill Weber is editor of Bloomberg Business Week on the Access line from Brooklyn. I love all the coverage you guys have been doing in Business Week, and I have to say, this is an area that we are getting a lot more guests. There's a lot of momentum out there, Joel.
Yeah, you know, it goes back to the before times. I remember I was in Milken, and it was like magic mushrooms had become even like a talking point there, and that was in 2019. And what we've seen since then is actually not only policy changes on state levels, but then just a flood of investor enthusiasm as well. But it's not all roses, is it, Kristen?
Not all rainbows and sunshine over here. I think one of the things that we forget when we talk about magic mushrooms, MDMA, all of the psychedelics that are really having a moment right now is that there is still so much we don't know. You know, these drugs were originally being explored back in the 50s and 60s as, you know, things that could really have a positive impact on mental health. But then in the late 60s, early 70s, we cracked down on them. Experimentation basically came to a grinding halt. And we had all these decades where we just weren't exploring how these drugs work. And so even though we've had these fantastic clinical trial results that show, you know, really, really breathtaking numbers of people who have been helped by these drugs for disorders like PTSD and depression, we still don't understand at a very basic level how the drugs work. And I think coming to market smoothly will rely in part on figuring out some of these basic science questions.
Well, Kristen, it's really interesting to hear you say that if you look at the clinical trial results, very promising. But I mean, I cover marijuana stocks all the time, for example, and they have just been beaten and beaten up in the market, mostly due to regulatory concerns. I would imagine in psychedelics, it's even more dramatic.
Yeah, I mean, there are some concerns. Studies have shown that these drugs are in large part very safe, but in specific instances, for example, people with histories of suicidal ideation, or maybe people who have psychotic illnesses like schizophrenia that run in their family, there could be a high risk component. Plus, there's just all of the decades of cultural baggage that go with these drugs. So there is definitely, wanting to keep safety in mind. Plus, this has already come out a little bit as we move forward in clinical trials. There, when you have a therapist in a room with somebody who's like, out of their mind tripping, there's also a lot of potential for abuse, which is true in any healthcare scenario, right? There are stories of abuse that pop up in all kinds of healthcare settings, but because a person is, basically out of it when they're undergoing the therapeutic process, that opens a door for more of that. So I do think that there is one segment of this industry, of this, leg of science that is wanting to, go slow and steady and make sure that as we roll these drugs out to people that, we're not only trying to roll them out quickly so that we're getting them to people soon who are in desperate need of drugs that can, treat some of these disorders, but we're also doing it safely so that we don't wind up in a situation where something terrible happens and then there's, backlash to deal with.
And so I'm curious, Kristen, I mentioned the flood of money. There's startups in the space, but what did you all learn since, there's different approaches that different companies are obviously taking. What's it look like from an investment standpoint right now?
Yeah, that's actually really interesting. I just checked my notebook here. One estimate puts that this industry could be at about $6.9 billion in a few years. So huge market potential. But one of the things that's interesting about psychedelics that's, sort of different from your average pharmaceuticals company's playbook is that you're dealing with things that have been in existence for a long time. So you have to figure out where the IP is. And people are taking different approaches. There's one company that has sort of been villainized by some Compass Pathways that their strategy has been to try and create a novel psilocybin molecule, right? So they're tweaking the sort of crystalline structure in the lab. They're synthesizing it and tweaking that structure and saying it's something new. But then you have people pushing back and saying, well, it's not actually something new. You're just riffing on something old. So the debate gets very complicated there. And then there's other companies that are saying, we're not even going to deal with trying to prove that our, version of this thing that has been in existence forever is new. We're going to instead find IP in other places. Like, for example, we're going to come up with, we're going to come up with a way to grow the mushrooms super efficiently, and we're going to patent that. So you have people taking really different approaches because, at the end of the day,
right.
Magic mushrooms have been around forever.
I have to say, Kristen, your story for anybody who's maybe investing in this space is a great primer on just kind of what you need to know about the history and kind of where we are today. Just quickly, got about 30 seconds. I mean, what does the Bloomberg audience, investors who are interested in this, need to know in terms of some of these startups? I feel like you just laid out some of it, and kind of separating the wheat from the chaff. And also, is it, the big pharma companies that are getting into this as well? Just quickly.
Yeah. What I can say is this is definitely going to be a really hot space. The question is, what form will these drugs take when they come to market? Is it going to be, a totally new drug that we make by taking some elements of psychedelics and turning them something new into a laboratory? Or is it going to be just finding the right sort of platform to roll out, psychedelic mushrooms in their original form to people? Right. So I think that's the big question is, not will these things help people, but how? What is the way this is going to come to market?
A great way to tie this all up. Okay, Kristen, thank you so much. Kristen Brown, healthcare reporter at Bloomberg News, on the phone from Brooklyn. And on the Access line in Brooklyn, Jill Weber, editor of Bloomberg Business Week. This story will be highlighted in the new issue of Bloomberg Business Week out later on this week.
Countdown to the Close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Taylor Riggs, Gina Martin-Adams, joined now by our colleagues Carol Massa, Katie Greifeld in for Tim Stenovic. We together welcome across our audiences of TV, radio, YouTube, a moment to digest what feels like pretty risk-averse sentiment. Volumes are thin, but we are off by 2.6% on the NASDAQ, Carol.
Yeah, across the board does feel like risk sentiment off here in the United States. But if you're looking for some performance here, check out the listings of Chinese companies here in the United States, those ADRs, pulling up the NASDAQ Golden Dragon China Index. It's up about 1.5%. This has the PBOC overnight calling on lenders to stabilize credit growth, so basically continue lending. This index, by the way, up more than 30%, Katie, since mid-March.
Definitely a bright spot in what is a very down market. And if you look at what's happening in the volatility landscape, in the VIX, what a move higher. We've been talking about how low the VIX is. It's still low, but it's at 24. It's looking at 25. On a points basis, this is the biggest one-day up move in the VIX in about 2 months or so.
But everybody's still so complacent. Why is that?
And maybe some of that complacency been drawn out of the market. And it didn't just start in the US. I look at WEI function on the Bloomberg. Actually, the only ray of green, Carol, to your point, is the CSI 300 over in China. Every other major benchmark, particularly in Europe, we're trading lower as well. And we're currently off by more than 2%. We're at 2.2% lower on the S&P 500. The Dow is your outperformer, but it's still off 1.9%. The NASDAQ is your underperformer, off by 2.5%. That's 321 points lower. And the Russell 2000 small caps really not finding any sort of bid either. We're off by 2.2%.
Yeah, and not only just a broad-based loss overall for the globe, but definitely broad-based losses across the U.S. market as well, with all of the major sector indices down on the day. Energy taking the least of the pain, but consumer discretionary tech, once again, we're back to that sort of growth is bad, get out of the growth stocks. This is where all the valuation premium built up over the last couple of months, and back to the value and sort of yieldy trade, which is definitely not a good sign of a persistence of risk tolerance. And that's reflected in the breadth right now.
Let's talk about those sort of growth stocks. Tesla maybe being sort of a classic example of that, Gina, as you rightly bring up. Of course, some of the sort of fundamental news, if we will, raising that self-driving feature up to 15K from 12K. Again, some of the other macro headwinds coming in as well. AMC, we've talked about from an unwind of some of the meme trades, as well as the AMC preferred equity shares that are also trading, so that stock under pressure as well. On a down day, I always like to point out what is rising, and to me, Signify Health, certainly one of those. There were some reports, United Health, Amazon, even CVS, looking to buy this healthcare technology company. And then we push forward to 1 hour from now when we're gonna get some news about Zoom, the quarterly results. Actually still a profit on the bottom line, Caroline, which I think is interesting. Growth at any cost firmly behind us as we have some profitability here, but it's a refocus on that top line revenue growth. Is it now going to actually be some of the slowest top line year-over-year growth that we've seen in this country's history, company's history, excuse me. And then of course, how do we think about some of that big enterprise spending underway?
And I like that you bring up the fundamentals, because I want to go back to sort of the technicals in place at the moment on this market, because you brought up so rightly, Taylor, earlier, that maybe, you know, this 2-month worst sell-off in 2 months is kind of right around the time where we just had a $2 trillion of options closing out. But we also have actually pretty bearish sentiment. I feel that you can cut this market in any way you want, but I'm going to cut it this way at the moment, thanks to our Dan Curtis, really showing that the positioning at the moment on the S&P and also in your 10-year bonds, in the futures part of the treasuries, there are pretty large short positions there at the moment in both your stock and your bond portfolio. So your 60-40 ain't working.
Yeah, right. We continue to wonder about this, you know, traditional investment strategy that has worked for such a long time. One of the things that I think about, and I'm obsessed with this story that is the most read on the Bloomberg, that has to do with large bondholders. We're talking about the likes of PIMCO and others, who are basically saying this low inflationary era is gone for good. And among them is Tiffany Wilding. She's North American economist at PIMCO. And she said the last 20 years of the great moderation, that's fully behind us now. That's her quote. She anticipates a period of high volatile inflation as the world adjusts to changes that will, quote, lead to higher input costs in general that should result in a multi-year price level adjustment. So, all right, team, I'm going to put this out to you. Are we ready to commit to this idea that we will be living in kind of, Katie, a new era of high inflation for a long time?
I have no opinion, but if you look at the market
Yes, you do.
and what the
I know
market
you
is
do.
pricing, if you look at break evens out to 10 years, I mean, I see them trading at about 2.6% or so.
But are they wrong? And that's what they're saying.
That's the question. I mean, I'm just going with the sort of herd mentality right now. That is such a reduction from where we were in April, even up above 3% or so. So, I mean, long-term inflation expectations don't quite marry up with that, but I mean, that's what makes a market.
Hard to bet against PIMCO, of course, sort of the traditional bond kings, Gina, when we think about some of the big market calls, and it sort of brings up, gosh, some of that dirty words of stagflation again. And I think we've been thinking about a lot of comments that I heard this morning in the 9 o'clock hour from some of the big strategists over there that inflation's going to come down a lot quicker than we thought. But again, it's sort of that level at which it levels out at. If it comes from 8.5 to 7, that's great. But do we stop at 7 or do we keep going down?
Right. And I think that is absolutely the key question because, of course, inflation is going to slow in an environment where we may or may not be headed into recession, where we know that demand is going to decelerate. But where are we going to end in 2 years? And back to Katie's point, the bond market is just entirely unconvinced, refuses to give up the ghost on this idea that we're in the great moderation. That is a huge risk to stocks and assets at large over the course of the next 2 years, because I happen to fall on the side of, with an opinion that yes, inflation is going to be stickier, probably higher and more volatile due to structural forces that have really shifted and now are backstopping and stopping a very different inflation environment going forward. But the bond market disagrees with me right now.
And the equity market at the moment, you can have a David Kostin on one side saying it's time to get bearish. You can have Ned Davis, the analyst over there, saying it's time to get bullish. And you can have, well, I read the note last night of Morgan Stanley, Andrew Sheets, saying, get into cash. They think that cash is king at the moment in terms of where's best place to park your money.
Well, there's so many different opinions out there, and I do wonder if, the smarter conversation is looking at some of these macro trends. I mean, look at what is going on with energy over in Europe specifically. None of this is expected to right itself anytime soon. We're transitioning, I've said this over and over again, to an alt energy space. That
Pivoting,
means,
if you will.
I'm not going to use the P word, but you do wonder about some of these macro trends, this pushback against globalization. If we're bringing more stuff at home, what does that mean in terms of higher labor costs or access to commodities, which are limited in terms of some of these natural resources? They're not unlimited. So how does that change the macro story going forward?
And it's interesting to think about a macro story where, I mean, the Fed could be cutting rates next year, and you have Europe still dealing with very, very high inflation, sort of this desynchronization of central bank policy.
This is pretty heavy for a Monday, guys. I don't know about you, but
I thought it was Friday.
She did. I had to tell her it wasn't. All right, we're going to be back in less than an hour's time. Our cross-platform coverage on the markets, on radio, TV, and YouTube. It is called Beyond the Bell. We will count you down to the close on this Monday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It is kind of heavy.
It is kind of heavy. That was an intense discussion. But I mean, think about where markets are right now. It's a heavy day in markets and mood music very, very sour at this point.
And yet we've had such a bounce, certainly on the equity side of things, right? And still even rates, even though that they've moved up, they're still low on a historical basis, right? So it's not like complete retrenchment, right?
I don't know. I mean, it feels like the twin debates that are going on right now is, have we seen the peak in yields? Have we seen the bottom in equities? A week ago, I feel like a lot more people were comfortable saying, oh, we've seen the bottom. But then you see just the widespread losses today and that conviction. It's hard to hold on to.
And to see that 10-year. Like, I agree with Gina in terms of, I agree that inflation is going to come down. I agree that some of the constraints that we've seen was the result of the pandemic, these supply chain snarls. But I also think, and based on some of the research that's out there, that we're not necessarily going back in inflation to the levels that we saw pre-pandemic.
That's the thing. Like, we'll probably, I mean, I don't have an opinion, but you could see a situation where we plateau at some of these.
She's just smarter than me. She doesn't share her opinion on air.
Maybe it's not 8.5, but maybe it's 4, maybe it's 5. That's still very high inflation. If you think about what we would have thought about that number back in 2018, 2019.
Absolutely. Yeah. And what does it mean for valuations and just kind of all of the theories, whether it's investment theories that we kind of have been using for years based on lower inflation. So anyway, Yes, it's a heavy Monday because it's a heavy week. Thank you, Jay Powell and Jackson Hole and all that good stuff. Right now, also heavy, a lot of the world and national news. On that is Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. Dr. Anthony Fauci says he'll step down from his various government jobs at the end of the year. It's something he teased a month ago. This is what he said July 22nd.
I'm not going to retire. I may step down from my current position at some time.
Fauci, in today's statement, says he is not expecting the traditional retirement because he says he plans to travel, write, and promote government service. President Biden says Fauci's commitment to his work is unwavering, and he does it with, quote, unparalleled spirit, energy, and scientific integrity. The judge who signed the warrant authorizing the search of former President Trump's home has issued a formal order today in which he says he remains inclined to make portions of the affidavit public. The Justice Department has been given a deadline of Thursday to propose redactions to the document. Judge Bruce Reinhart says no one from Trump's legal team has intervened in the decision. Russia's top counterintelligence agency is blaming a Ukrainian spy for carrying out the car explosion that killed the daughter of an ally to President Putin. Former U.S. Ambassador to Poland and Atlantic Council fellow Daniel Fried tells Bloomberg he doesn't buy what the Russians are selling here.
They have identified a woman, a Ukrainian operative, who carried out the bombing and left her ID somehow behind for them to pick up, which identified her as a member of the far-right Azov battalion, the Ukrainian fighting group. That's just nuts. An operative is going to carry out a bombing and, drop their ID?
Daniel Fried says the Biden administration has heard it was a Russian source operation. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
I know. Is it Friday yet?
I wish, man. But thrilled to be here. It's going to be a big action-packed week.
It is. Carol Master, Katie Greifeld. Katie's in for Tim Stanovic on this Monday on Bloomberg Business Week here on YouTube and in our Interactive Broker studio. Hey, a couple stories that we wanted to mention within the auto world. First of all, Tesla raising the price of its driver assistance system to $15,000. This story, can I be quite honest with you? I'm like, okay, why do I need to know this? Was this something new? Did they not charge for it before? And I guess the current price is $12,000, so they're upping it by $3,000.
And it's also it's the second time that they've raised prices this year, which is pretty amazing. And of course, this is a very controversial product, the full self-driving. It's been a lightning rod because it requires active supervision. It doesn't make the company's vehicles autonomous. California's Department of Motor Vehicles actually has accused the company of misleading consumers about full self-driving.
Right, exactly. You still have to. You can't spin around and do some
You can't take a nap.
play cards. You can't take a nap.
You have to pay attention.
All right. So anyway, it's going to cost more, it looks like. The other story we want to bring to your attention has to do with Ford, saying it's cutting 3,000 jobs this week in a move to boost profits as it seeks to fund the $50 billion it plans to spend on electric vehicles. Okay, here's where we can use the word pivot, right? Safely.
Yeah, no, definitely. I agree with that. It's safe to use the pivot here. This is interesting because these cuts will come primarily in the U.S. Some positions are also being eliminated in Canada and India. The total includes about 2,000 salaried workers and 1,000 contract personnel for Ford. Most are coming from Ford's operations that build the traditional internal combustion engine vehicles.
Yeah, ICE. CEO Jim Farley has said he wants to make the, quote, the profit and cash engine for the entire enterprise. So he's looking to really make that pivot and shift towards EVs, which we're seeing GM is doing the same thing. And this is why we talk about more competition for Tesla. But it does feel like this year, and we've seen Bloomberg do reporting on kind of almost the tipping point when it comes to EVs. We are seeing it globally, more and more cars, EVs, hitting the road. All right, you are listening and watching Bloomberg Business Week on this Monday. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
So we've got about 43 minutes until the closing bell. Today, both stock and bond markets are facing a little bit of pressure in front of Fed Chair Jay Powell's speech on Friday. He will be talking at the Fed's Jackson Hole Symposium. He's likely to dismiss this idea of the Fed pivoting away from a hawkish stance on terms of raising interest rates. Let's get you the very latest now on market action as we cross to the Bloomberg Macro Squawk Desk and Bill Maloney. Hey, Bill.
And good afternoon, Doug. And with that being said, stocks have been under pressure from the start this morning. Dow's currently down 638 points. S&P's dropped 88, while the NASDAQ is lower by 2.5%. The U.S. 10-year yield at 3.03%. Gold is down 9. Oil is little changed. And Bitcoin is down by 2%. Among the main 11 S&P sectors, all were trading in the red, led by losses in consumer discretionary and tech. And every stock in the Dow is also in the red, led by 4% losses in Intel. In deal news, CSI to be acquired by Centerbridge and Bridgeport for $1.6 billion. In other news, the Adidas CEO is stepping down in 2023. And wrapping things up, Palo Alto Networks and Zoom Video report after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, thanks. And to get live breaking news right on the Bloomberg terminal, the function is SQUA, then the green go key. All right, I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, really appreciate it, Doug. Well, this next half hour, we're going to talk a bunch about healthcare, thanks in part to Signify Health. The stock soaring the most since its shares started trading last year, thanks to multiple big-name suitors, including Amazon, competing to buy the home health technology and services provider. That's according to people familiar with the matter. I mean, there is so much interest in this company, Katie.
And I'd never heard of this company before until apparently everyone and their mom wanted to buy it.
Exactly. Let's get more on what's going on. Bloomberg News healthcare M&A reporter Michelle Davis joining us in our Bloomberg Interactive Broker studio. So great to have you here with Katie and myself. Who is this company?
Yeah, Signify Health is a company that IPO'd last year based in Dallas. They get most of their revenue doing these, helping to facilitate these like home health assessments where like basically they'll send a nurse or, doctor to your home and they'll check someone's vitals, check out the layout of their home and see, oh, maybe like they're not in the best neighborhood and there's a lot of noise pollution. There's all this stuff. So they take down all this data. This person it doesn't seem like they're keeping up with their prescriptions, that sort of thing. That's how they get most of their revenue. But because they are in people's homes, they have a ton of data on people. And so that's the big theme around all of this interest. Like if you are, so what we reported today is that, everyone from Amazon to CVS, United Health, massive insurer, and this company Option Care that's partly owned by Walgreens, they're all vying to buy Signify Health. And a big part of that is because they want the data that Signify Health has.
And the stock is up 31% as we speak.
But it's sort of the diverse set of potential suitors here that caught my eye because, okay, for sure, CVS, I get that. Amazon raised my eyebrow a little bit more, but I guess to your point, it's all about the data here when you think about a company like Amazon. Yeah, and so for a company like Amazon, they have been increasingly, not just dipping their toes, but really getting into healthcare in a big way. Just last month, we saw them buy One Medical. That was another company that we reported CVS had also looked at, so we're just seeing them, duke it off right here again. But so this is a way for them to get into like the home and also have data to help them maybe like lower healthcare costs. That's what they say their goal is, without actually becoming a regulated insurer. Whereas for CVS, there's a way to, if you have more information about your members, you ideally or theoretically you could help keep them healthier, which means less money that you're spending on them. So if this person's like high risk for blah, 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 then, you can make tweaks and send people into the homes more often. And for CVS, there's like a cross sell where if they have access to these people and know that maybe they need to pick up their prescription, maybe the hope is they'll go to CVS and then buy some makeup or,
like this.
buy shampoo.
Maybe you need this.
Exactly, yeah.
Well, I do wonder about, so how do you, as someone who covers healthcare M&A, think about Amazon specifically as now, since here it is again, they're not just, it feels like dipping their toe anymore, they're like kind of jumping in big time in the healthcare space. How do you think about them and their role in healthcare going forward?
It's a really good question, and it's funny because, up until earlier this year, people had known that Amazon was pushing into healthcare, but we really hadn't seen them do too much, and so they'd kind of fallen off the radar. But now after the One Medical deal, any company that people talk to me about, they're like, oh, well, Amazon could be a buyer for that. It's like suddenly...
Any of the M&A bankers?
People, investors, sources, that sort of thing. Like everyone's like, oh, Amazon, could buy it, because suddenly everyone remembers that they are trying to do healthcare. And so it's a name that everyone throws out. And they have the heft to look at everything. It's still, it's unclear, we don't know yet how this one's going to go. Final bids aren't due for a couple weeks. There's always a chance, one of the parties gets eager and decides to preempt, and that means, they just submit a bid earlier to kind of beat out or win out. And then with Amazon, I know historically they hate leaks, and actually in the proxy for the One Medical deal, it said that when they sent over their letter of interest to One Medical, they said if our interest leaks, all talks are off. I don't know if that would happen here, especially given how competitive it is.
Yeah.
Depending on how much conviction they have, that might not be the case. But that's always something to think about as well. It's I don't know how it's going to go, but Amazon's definitely they're looking and they're reminding people that we're serious about healthcare.
And Michelle, there's also a chance that Signify could remain independent here, right?
Definitely. Yeah. That's always, nothing is certain at this point. If it turns out that, the Signify, board and management don't feel that the offers that have come in are attractive enough, they could just kind of table things, as we've been seeing that a lot recently, where there's been a big disconnect between, where a company sees its value and where the market is valuing it, just given
Although
how
with
much...
4 suitors. The one thing I want to ask you, in general, healthcare, M&A, is there a lot of stuff going on? Because I feel like this is one of the industries, the areas of our world that has been slow to innovate and disrupt, but I feel like it's picking up momentum.
Oh, yeah, it's been super busy. Healthcare M&A is the second, it's the, if not most or second busiest after tech, 20% of the economy. And there had been a drop off in the, volume of biopharma M&A, but we're starting to see that pick up again as well. Just because all the big pharma companies have so much cash that they are dying to spend, and they have, tons of drugs going off patent, which means they need to acquire more things. So, yeah.
Just real quickly, Oak Street Health, Cano Health, I hope I'm saying it correctly, CareMax, these all jumped as a result. Just got about 20 seconds. Might something happen with these properties too?
Yeah, there's been a lot of speculation that those are companies that could get taken out, especially, by whoever doesn't win, here. They'll be interested in buying something, so.
It's like, what's next?
Yeah.
A space that's definitely on the move. Michelle Davis, thank you so much. Really appreciate it. Healthcare M&A reporter at Bloomberg News here in our interactive broker studio. As we mentioned, shares of Signify Health, they're up almost 32%. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, this is Bloomberg Business Week. I'm Carol Masser. Tim Stanovic is off this week. Katie Greifeld joining me on this Monday. We just talked about Amazon and others pursuing Signify Health. We're going to also talk about the Inflation Reduction Law and how that might impact healthcare as well with our next guest.
Yeah, I'm looking forward to that because we've covered it from a lot of different angles. I haven't yet heard it from this one.
All right, so we'll get to that in just a moment. First up, though, back to your top business stories. A look at that trade. Here is once again Doug Krisner.
Hey, Carol. So we've got about 28 minutes until the closing bell. The equity market has been on the defensive for the entire day in front of the speech that we're expecting on Friday from Fed Chair Jay Powell. Many officials at the Fed have said repeatedly that interest rates are going higher. Nonetheless, there have been a few in the market that have speculated on a looming Fed pivot in the Fed's thinking, and that would tie to a lot of the weakness that we have seen, right, in the economy. Nonetheless, inflation does remain high, and Powell is likely to emphasize that fact, as well as the Fed's commitment to fighting it, even if it were to cause pain. I think the risk of recession right now is foremost in the market's thinking. You look at the semiconductors today, the Philadelphia Semiconductor Index is down about 3.9% right now. It's really bearing the brunt of the selling that we're seeing in technology stocks overall. NASDAQ Composite is down about 2.6% right now. We've got the Dow Industrial Average weaker by more than 2%. Dow Industrial Average, check that, is down 2%. S&P 500 down 2%. NASDAQ Composite, I mean to say, is down more than 2.5%. Generally speaking, the market has been defensive, and there's been a lot of volatility in the price of crude oil. We ended the regular session down just 0.2%. WTI 90.23 at the close, but at the low point of the day, we were 86.60. The Saudi Arabian oil minister said that the extreme volatility that we've been seeing in the oil market, as well as the lack of liquidity in the futures market, really beginning to disconnect from the fundamentals, and that may force OPEC Plus to act. I think there's been a lot of concern expressed in the oil market about weaker global growth, along with the possibility that we're going to see more Iranian crude coming to market. We'll take another look at markets for you in about 15 minutes. Back to Bloomberg Business Week. Carol.
All right, Doug Krisner, thank you so much. Appreciate it. Well, we're going to continue taking a look at the healthcare sector, and we mentioned Amazon and others pursuing Signify Health. That is certainly one of the company stock market stories that we're talking today. And then, of course, we have the provisions in the just signed Inflation Reduction Law that includes info and provisions on drug prices and the Affordable Care Premium. So let's bring in Deborah Netchart. She is Health Sciences Portfolio Manager at the Registered Investment Advisor Jennison Associates. They have roughly $171 billion in assets under management. She joins Katie and me on the phone in New York City. Hey, Deborah, good to have you here. How are you thinking about the healthcare sector right now? We talked about Signify Health. We've got United Health, CVS, Option Care Health, and Amazon all pursuing. And then you've got the Inflation Reduction Act. There's a lot of things that can certainly impact this space right now. How are you seeing it?
And it's one of the largest drawdowns we've ever seen in the sector in and of itself. So if you look at biotech, there's a lot of opportunity in companies that are